Hey everyone, this week we're going to focus in on what's happening with the employment market and how that's affecting commercial real estate. The employment market is generating some really strong numbers right now. They added about 263,000 new positions in April, and that took the unemployment rate down to 3.6%. Now that's the lowest rate in about 50 years. So far through April, we have added about 820,000 jobs, which is down about 7% from last year. Though 2019 is off to a really good start, we could face some headwinds in the coming months. The very low 3.6% unemployment rate is a double-edged sword. The number of people looking for work right now is exceptionally low. Only about 5.8 million people are looking for work. Currently, there are about 7.5 million job openings. So there's definitely a labor shortage and a skills gap. This is placing upward pressure on wages and thinning the talent pool, and that could slow the pace of hiring later this year. Two of the property types that are seeing significant wage growth impact are seniors housing and hotels. Both face higher than normal wage growth, and the rising wages are going to have a significant impact on their operating costs because labor is one of their highest cost segments for those businesses. Another potential headwind is small business optimism. It's begun to ease back as companies are looking forward and wondering what's around the next corner, and that's weighing on their expectations for future hiring. So what's this mean for commercial real estate? The strong job market, of course, is really good for all types of commercial real estate. More people with jobs and higher wages means there's more disposable income, and that's actually at an all-time high. That elevated disposable income translates into more spending and consumption, and that drives demand for both retail space and industrial space, of course, because of e-commerce. More people with jobs means household formation is accelerating. We're pushing workforce department vacancy rates lower, especially in the Class B and Class C, where vacancy rates are at their lowest first quarter level since 2001. Leisure travel is also elevated, which is keeping hotel occupancies at a record 66.3%. And of course, office vacancies are declining. They're down about 20 basis points from the first quarter of last year to 13.2% as companies add space for increased staff. So what should investors do with this information? The economy is pretty much firing on all cylinders, and commercial real estate's outperforming. The fundamentals are really good. But investors need to look forward. There's certainly risk to the outlooks, particularly when you consider the 2 to 3 year horizon. Because of the hold period, most buyers are already baking in a slowdown into their valuations, and that's weighing on their bid pricing. That's part of the bid-ask spread that we're encountering because things are so good right now. Sellers are trying to price at the top of the market, and buyers are factoring in that slowdown. So investors should consider their portfolios. Which assets do they want to hold through the next cycle? Anything that doesn't fit into their longer-term portfolio strategies should be put on the market soon because you can still offer the upside and the market runway that's there today, and you can price the markets to sell.